Hi, everyone. Today, we're diving into an essential topic for anyone in finance or investment, rates and returns. This presentation is part of the CFA Level 1 Quantitative Methods curriculum, and by the end of it, you'll have a solid understanding of how interest rates and returns are calculated, interpreted, and applied in real-world scenarios. Let's get started. Before we dive into the details, let's outline what we'll cover today. By the end of this session, you'll be able to interpret interest rates as required rates of return, discount rates, or opportunity costs. Calculate and interpret different approaches to return measurement. Compare money-weighted and time-weighted rates of return. Calculate annualized and continuously compounded returns. Understand major return measures like gross, net, and real returns. These concepts are foundational for anyone analyzing investments or managing portfolios. So let's break them down step by step. Let's start with interest rates. At their core, interest rates measure the time value of money. They can be interpreted in three main ways. As a required rate of return, the return investors demand to lend their funds. As a discount rate, used to calculate the present value of future cash flows. As an opportunity cost, the return you give up when you choose to consume now instead of saving. Now, let's talk about the real risk-free rate. This is a theoretical rate with no inflation or default risk. It represents the time preference, how much we prefer current consumption over future consumption. However, in the real world, we deal with nominal risk-free rates, which include an inflation premium. The relationship between the two is this formula. Additionally, securities often have risk premiums, like default risk, liquidity risk, and maturity risk, which increase the required rate of return. These premiums are added to the nominal risk-free rate to reflect the additional risks investors face. Next, let's talk about holding period return, HPR. This is one of the most straightforward ways to measure an investment's return over a specific period. The formula is this. For example, if you buy a stock for $20, receive $1 in dividends, and sell it for $22, your HPR is 15%. If you're measuring returns over multiple periods, you'll need to account for compounding by multiplying the HPRs for each period. This gives you the total return over the entire investment horizon. Now, let's discuss two key ways to average returns, the arithmetic mean and the geometric mean. The arithmetic mean is the simple average of periodic returns. However, when returns vary significantly from period to period, the geometric mean is more appropriate because it accounts for compounding. For example, if you have returns of minus 9.34%, 23.45%, and 8.92% over 3 years, the geometric mean return is 6.825%. This reflects the compound growth rate of your investment. Another useful measure is a harmonic mean, which is particularly helpful when calculating the average cost of shares purchased over time. The formula is this one. For example, if you buy shares at $8, $9, and $10, the harmonic mean price is $8.93. This is always less than the arithmetic mean, making it a better measure for average cost calculations. Now, let's compare money-weighted and time-weighted returns. Money-weighted return is essentially the internal rate of return, IRR, of an investment considering all cash inflows and outflows. It's sensitive to the timing of cash flows, which can distort performance evaluation. On the other hand, time-weighted return measures compound growth and is unaffected by cash flow timing. It's calculated by multiplying the holding period returns for each subperiod. For example, if you have returns of 22% and 10% over 2 years, the time-weighted return is 15.84%. This is a preferred measure for evaluating portfolio managers because it removes the distortion caused by cash flow timing. Sometimes, you will need to convert returns from a shorter period into an annualized return. The formula is this. For example, if you earn 0.75% over 90 days, your annualized return is 3.08%. This allows you to compare returns over different time periods on an equal footing. Another important concept is continuously compounded returns. These are calculated using the natural logarithm. For example, if you buy a stock for $100 and sell it for $120, your continuously compounded return is 18.23%. This method is useful because continuously compounded returns are additive over multiple periods. Finally, let's discuss major return measures. These include gross return, total return before fees; net return, return after fees; pre-tax nominal return, return before taxes; after-tax nominal return, return after taxes; real return, return adjusted for inflation, calculated as below; leverage return, the return on an investment that uses borrowed funds, calculated as following. These measures help investors understand the true performance of their investments after accounting for fees, taxes, and inflation. Here are the key takeaways. Interest rates can be interpreted as required returns, discount rates, or opportunity costs. Holding period return, HPR, measures an investment's return over a specific period. Geometric mean is used for compound returns, while harmonic mean is used for average cost calculations. Time-weighted return is preferred for evaluating portfolio performance. Annualized and continuously compounded returns allow for comparisons across different time periods. Major return measures like gross, net, and real returns provide a comprehensive view of investment performance. That brings us to the end of the presentation. I'd now like to open the floor for any questions or discussions. What aspects of rates and returns would you like to explore further? Let's dive deeper into any areas that need clarification.